Hi everybody, this is Murugan. I'm a SEBI registered investment analyst. Happy to present one another video from Equisys. I understand it is after a long time we present another video, but this time we see a purpose to present this video. Because we now get a lot of people asking questions like, Murugan, how do we plan for this election results, which is May 23, this Thursday. So is there any big plan for it? If you remember, I think about 5 years before we posted an election video, where we got a good feedbacks, and in fact, as per our expectation, the market really pan out, even on a live coverage we presented. But this time we see a good strategy where we can look for a high returns, but of course there is a risk, but we see the risk is on a low probability as well as the low risk profile. So we thought, why not we can present it to you people and we leave it to you. So let me first explain things forward. So this video first I'm going to talk about two things. How am I defining my probable case? Where exactly a market to behave? And number two, I'm talking about the trading strategies using options with the expiry of May 30, which is not this weekend. I'm presenting this video on 20th May, but we are developing the strategy by keeping 30 May as a strategy. Okay, now, what are the probable cases we are expecting? Okay, now look at this one. We are expecting results on May 23. The counting starts from morning. So there are few cases we have. Number one is stable government. When it comes to a stable government, remember we are not talking about UPA or NDA. Anybody who comes with majority, market may appreciate. So anybody managed to cross the threshold, which is a majority mark, it is seen as a stable government. Probably can government do a lot more things, which is into policy initiatives, lot more things. So if that is the case, it is seen as a very positive aspect to the market. So let's see how a market may behave for that. The other case we are looking at as a challenging case. So where the party one, party two, which is a major parties, but unable to get the majority, but they were totally dependent on others. So if you look at this particular case, with the help of others, party one or even party two can actually form the majority. In case, if it is totally unpredictable, that what sort of competition, what sort of bargain, it's very difficult to guess anything over here. So this is something which leaves into a volatile scenario. It is actually dicey, like how it is going to form. It takes a time, but it doesn't becomes a hung parliament. I'm sure others may not, others become powerful, but they have to join hands with someone. But if you look at the third case, which is a worst case, where party one, party two, even others are equally good. So if that is the case, even this is the time you see the people say like a third party is joining hands, and there are diverse opinions, and that is where a lot of chaos taking place. That I see it's a worst case scenario. So the idea is anything can happen. So although we see an exit poll which is slightly positive for one government to come with majority, but it's still on the speculation note, so it may or may not happen. And number two, this is the time we are actually understanding that the market behavior, especially today, Monday, the market rallied close to 450, 500 points. We assume that the market is speculating it. Market is not aware of this. Market cannot discount this, because I'm sure, although it is an exit poll, it is the market expectation, the market trying to discount. But remember, market is not aware of the results. So that's a fact. So it is based on the expectation, all these positions been built. So how a market behave? So now I should first give you an idea, like what are the expected behavior out of the market. So where am I expecting Nifty to go? Let's say if a stable government appeared, I'm sure it is a disappointment to a bears. Anybody looking for chaos in the government formation becomes screwed, and I'm sure you see a short covering rally takes place. But as the short covering happening, you see the price tends to go upside. That is what any good news, any stable government, it is natural that the price to go up. But remember, as the price goes up, those who created a long position on Friday or even Thursday, they were already in a profit of 500 rupees. We didn't see much of profit booking today, because today the market were consistently on the higher note. So the bulls were sitting on hope, but the shorts who already created on Friday and Thursday were under loss of 300, 400 points. So their unwinding, the short covering made the price to go further up today. So now what we see is, let's say a guy who created long on Friday and short on Friday, let's say there's a two different party. The bull is in profit of 500 but didn't book a profit because it is hoping for a stable government. So he is expecting a little more rally to take place. But the short is already tired. Some sort of unwinding has taken place that made the price to go up. What does it tell me? That market gives too much of weight for the exit poll. The lot of bullish things is being started discounted in the market. So what can happen? Look, now the short positions got transferred from one seller to another seller. Okay, now till yesterday I am a short guy, okay, who was hoping the price to go down. But let's say if I'm under loss of 400 to 500 points, I said enough is enough, let me exit. So today the short people who placed the buy order made the price to go little up, but there is another person who equally created a short position. So we didn't see much of unwinding today. In fact, we had seen a transfer of contracts. In fact, the open interest got gained. It means the bulls remains in the contract. There are a little more short. Said everyone with me. The few longs were up, and a lot of short positions might have transferred on an aggressive note. So short covering was rallied up. So today's scenario tells me one thing, that the bulls are sitting in a good profits, but the short positions was under panic. They started transferring. So by tomorrow, what is expected? Remember, short people may not panic because the new short is under loss of 100, 200, but the existing bulls are in a profit of 500. So by tomorrow, if a price, let's say as expected, if things are positive, further going up, the bulls may be, under a kind of happy note, they start booking a profit. Even if the event is as expected, as per the event, if lot of position is created, eventually it comes for unwinding. So that puts some selling pressure in the market that makes the price to go down. Okay, now I'm not expecting price to go down, but if a price goes up you don't see a free rally to take place on the upside. So every rally upside, the bulls may start selling it. So what happens on a stable government? From another 400, 500 points upside, but it is not that free to go upside. So we are expecting price to go to 12,200 to 12,500. Okay, now what may happen if it is a challenging case? Remember, in a challenging case, things become dicey. If it is not as per the exit poll scenario, I am sure there are some panic for bulls. They think enough is enough, let me book a profit, let me go off, play safe. That makes the price to start coming down because the bulls are now start placing a sell order. But remember, the boars, any bearish guys in the market, the bears start getting a hope. So they continue to hold the short position. But remember, any new short created today, okay, now any new short created, or those who already created a short position survive till now. Let's say that is very rare, but still, if they manage to survive, they feel cost to cost, thank God I got a chance to exit. So as the price starts moving down because of panic bulls, as they start selling, it may not even freely fall down. Remember, around 11,200 and 11,000 level, even the bears got a bit of profit in the book because in a challenging case, somehow the government can be formed, either with the others with the help of party 1 or others with the help of party 2. So in that case, things become dicey, may not have a much conviction for both bulls and bears. Bears just get a hope, may not become very aggressive. So they do look for a profit to book. So as the price comes down, you see a bit of buying. So around 11,000 to 11,200 sort of buying is expected. So we should be aware of that. So if it is a confused note even, we are not expecting a big free fall about the market. I understand out of election event, a high volatile scenarios takes place. Okay. So let me form a strategies by keeping that also in my mind. But a realistic expectation that even if a market goes down, of course, the bears do think about it, but we don't see a panic fall to take place at this case. But let's take the third case, which is a worst case, where nobody gets majority and there are a lot of competition. Even third parties started talking about forming a government. So that is where it becomes typically the hung parliament. So what happens? The bulls do get panic. The existing bulls short selling start booking their profits. Basically, long unwinding will come. Some bulls get screwed as the price starts moving down. The bears get a lot more hope. They hold their short positions. They don't see any reasons to cover their short positions. So it starts freely falling. And you see a big new bears do come up. But remember, it is a week of time. Of course, in a single day also, market can fall like anything. So I cannot be blind on the downside. But I think realistically speaking, around 10,500 or 10,000 level, market can find a kind of support. No, we do expect the fall in price, but not much out of this case. So in case if you have a differences of opinion in terms of our expected case, you make your point at the comment section. But the strategy what we gonna form using call options and put options by keeping these cases. So anybody who buy our case, anybody who also agree with our expected scenarios, probably can consider the below strategies. Look at this. Okay, now market is currently positioned around 11,850 levels. Okay, now lot of people were asking us, Murugan, shall we buy 11,800 call, 11,800 put? Anything happens, I make money. This is a right hedging strategy. Let me tell you one thing. Buying call, buying put doesn't mean you are actually risk free, because it comes by paying a lot of premium. Look at this here, 279 and 208 is a current premium that actually gives you, that actually takes a lot of premium from you. Basically, you are paying 487 rupees from your packet. So if you do that by buying both, you are actually paying a premium which is close to how much? 487. So if it is 487, your break even happens to be 12,287 and 11,313. Remember, after this election, we don't have much time. So a premium erosion is expected to be on a higher scale, not otherwise. So we expect you people to be cautious while paying premium. So don't be lavish about premium. Look at this. For you to make money, the price have to go about 12,287 or the price have to fall below 11,313. On a stable government, even we are not expecting market to go much beyond 12,500. Or let's say the expected case is around 12,300, where you just break even, you don't make much money out of it. So it is better avoid this. Murugan, if a price goes to 12,300, you make money. No, you are making 13 rupees or 100 rupees or 200 rupees, but not the money for the risk taken. See, you have taken a risk of 487. So the total risk, the premium you're taking is a 487. So ideally, you should take a good returns for the risk taken, at least on your expected case. So I think buying blindly on call and put now with high volatile scenario with such a high premium, we advise you people to stay away from the market, because our expected levels with this premium doesn't work for the risk taken. So what other people were actually doing is they were considering forming bull spread or bear spread or iron quarter. What they are actually doing is they are considering 12,300 call option, where I'm taking some premium out, and 11,200. So what they're doing is they are finding this as a fence and they start selling these options. By selling these options, what happens? So my risk is no more 487. My risk is no more 487. My risk has come down because I'm selling couple of options. So this increases my investments. But remember, even if I invest more, no problems, provided I get a returns for the risk taken. Buying options comes with lesser investment, but remember, it carries too much of risk. So it doesn't matter to write options, sell options. Don't tell me that we are actually investing a lot. But if it comes with good returns for the risk taken, go for it. Being a trader, we are concerned about returns for the risk taken, not for the returns for the investments. So this is a case, I think about selling options. But remember, this time also the risk is no 487, but still 342. But my returns are maximized to a limit, where my returns may not increase beyond 12,300. So my maximum return, by paying 342 as a premium, I get only 500. So my net return happens to be 158 on the upside. On the downside, if a price goes even 11,200 or anything below, I end up getting only 258. So kind of return I am getting is actually not great for the risk taken, because the risk I'm getting is 342, but the returns I'm looking at is 158 to 258. That's not a big deal. So even if a market goes down, I'm not getting a returns for the risk taken. And if you're not able to quickly calculate all these things, I request you to check with how a call, put options, other things work. Otherwise, you make your comments at the below section. We see how well we can quick up. But this video can be quickly understood only by those who got good understanding about buying, selling, and forming strategies. Okay. So now what should I do? So now we see people start selling 2 for every 1 buying. So actually in this case 1, 2, 3, 4 contracts I'm selling and 2 contracts I'm buying. Murugan, here the investment's a lot. But remember what happens by doing this. Your risk is no more 487, your risk has come down to 197. But your risk will start increasing beyond 12,300 or 11,200. So it is not a maximum risk, the risk may still increase. But the problem is the returns is not even great for even this aggressive play. So by investing lot, if I'm getting a good return for the risk taken, it is fine. But so selling too many, still not helping me. Then what really helps us? So we come out with this strategy. Look at this one. What exactly we are looking at it? We are expecting market to go towards 11,200 to 11,000 level. Why, Murugan? Because as I told you, already market 4-5 days, 2-3 days, it rallied much. So existing bulls were handsome profit, but the shorts were already covered their positions. Meanwhile, the fresh shorts were in the position. So fresh short may not panic as a bit of upside, but by tomorrow or day after tomorrow, any upside may leave you a bulls and confusion note, because the results may come 2 days after. But remember, any doubtful scenario make the bulls to book a profit. Let's say even a result is out, okay, the profit booking, and if it is a stable government, yes, it can go up. So maximum market can go to 12,300 to 12,500. Look at this. In a way, now I should reduce my risk. Even if a market is 12,300, I should not lose much. Even if a market is 12,500. So what I'm gonna do is, instead of buying 11,800 call option, I hope now you see 11,800 call option, I just take this out. So now what happens? Now I'm simply buying 11,800 put option, which makes good money as the price goes down. But remember, the kind of premium I pay is 208. So 208 is a hefty premium I pay, but that makes sense only if a market goes down. By any chance, if a market goes up, I lose 208. I don't want to play this way. So because the market can go up, as I told you, it can go up to 12,500 or 12,300. So how do I reduce my premium paid? So what I'm going to do is, I'm going to sell 12,300 call, and I also sell 11,200 put. So by doing that, I get something back which is close to 145. So my risk has come down. So it is no more 208. By selling this, my risk has come down. I hope you understand. 208 I pay from my packet as a premium. 78 and 67 I get by selling these options. So if I do so, but instead of doing that, I sell one more put option. So now if you look at this particular one, my risk is no more 208. My risk is no more 208. Since I'm getting this 78 and 67 and another 67. In a way, what happens now? Murugan, you're expecting price to go down. Why are you selling put option? I'm selling the out of the money put option to harvest the premium, which reduces me at current level. So remember, if I do so, my net premium paid is almost nothing. So if a market stays at current level, if a market goes by 500 points upside, if a market goes down, I'm not going to lose anything. But any tick below 11,800, I start making money. So I am really expecting market to go below 11,800. So I form a strategy in a way that I make good money when a price is below 11,800. So if a price is 11,500, I make 300 rupees returns. If a market is 11,200, I make 600 rupees returns. If a market is 12,300, I make nothing, but I lose nothing. 11,900, I make nothing, I lose nothing, because of net premium is 0. But remember, if a price goes anything above 12,300, I lose money. For every 1 rupee, I lose 1 rupee, because the call I sold may trouble me. So what happens? If a price goes to 12,500, I lose 200. But remember, the maximum return I am betting here is 600. So even if I risk that 200, I am looking for 600 downside. Is a good play is what I feel. So I'm not telling it comes with a risk free. I'm not telling it is a risk free strategy. It carries a risk, but the kind of returns we aiming is good for the risk taken. So if you see, as per my expectation, which is a stable government or even a kind of confused state, the market is expected to not to have a free rally on the upside. So even if it is upside 12,300, 12,400, 500, I'm not losing much. At 12,300, I'm not at all losing. At 12,000, I'm not losing. But 11,800 or below, I start making money. And look at this case, even if a price is 11,200, I make 600 rupees returns. Okay, now Murugan, what happens if a price goes below? Because you sold two. Look, anything below 11,200, every 1 rupee downside, I'm not going to lose two, because one will be financed by this put option. So at 11,000 level, I don't lose 200 plus 200, because this put option will be financed by this particular put option. So basically till 10,600, I'm not going to lose much. So my break even point happens to be 10,600. Let's say on a worst case, something happened and if a market get collapsed and it becomes 10,000, I lose 600. I agree. Because selling two options and the price is down by, the price is down by 1,200 points. It becomes in the money for 1,200 points. So in total, it becomes 2,400 is what I lose. But luckily, I have this put option. This put option which I bought can actually save me 1,800. So my net loss happens to be only 600. Look at this. Realistically speaking, as per even exit poll, some sort of majority is there. Not clear majority, at least close to the majority. So if that is the case, a government can even eventually get formed. So even in the worst case, even if the market goes to 10,800, look, I'm not losing everything. I am risking 600 for the returns. So remember, don't blindly form the strategy. Form a strategy in a way that we look for good returns for the risk taken. Okay, Murugan, to form the strategy, what should I do? Summarize it. I am buying 11,800 put option by around close to 210 or 208 rupees. Then I am selling 12,300 call option and I am selling 11,200 put options into two. In a way, my net premium paid is close to zero and my returns can be maximized up to 600. But if you see there is a hung parliament is what you really expect, a big fall is what you expect, then don't sell two here, you sell simply one. In a way, your net premium paid is close to 65 to 67. So your risk may be there at 67. Your profit is still maximized when the price becomes 11,200. But mark my words, you will not be under trouble when a market is freely falling. Murugan, what do you conclude out of this? Are you really bearish in the market? Technically speaking, today we are on the verge of breakout. But it is already lot of positions being created. Already lot of short coverings being taken place today. So even if a market starts moving tomorrow, we don't see much of short covering to take place. But form the strategy by understanding the risk profile. To form the strategy, I think close to 2.5 lakhs to 3 lakhs returns are expected, and we have close to 600 rupees net returns. So on at least about 300, 400 points returns, we are looking for at least 35,000 rupees returns on a maximum. But remember, you are taking a risk of around 60, 70,000 rupees. So this is really good for those who has a minimum capital of 10, 15 lakhs. So if you got a capital of only 50,000, telling me that Murugan, I risk all my money here, let me aim that 50,000. You are actually gambling, because you are not actually taking a consistency in the mind. You are not actually taking money management in your mind. So this is not the only trade where we being right or wrong. So there are so many trades like this we trade where the returns are good for the risk taken. Somehow we can swim in the business. Thanks for listening this video for so long time. Happy for watching you people till now. But I request you people, make your comments in the below section. Subscribe our videos. This encourages and motivates us to post something. So any differences in opinion, make a point. Okay, I leave it to you people to trade this or not to trade. But I hope you understand that don't just go as a mob behavior of buying call and put options. be aware of the risk. Thanks for watching this video again. Thank you. Happy trading. Be aware of it. Play stop loss ahead of elections.